Good morning. This is Andrew from Trend Following Mentor. Today is March 20th, 2014. Just wanted to do a real short video. And just before I start, this is for educational only. None of it is made for any personal advice, and all the disclosures are actually on the website, and also I put on the bottom of this video on YouTube. Yesterday was a very interesting day. I manage money. I'm a commodity trading advisor, and I went to a fund of funds. And in the course of conversation where they were basically interviewing me or asking me all kinds of questions, I asked them questions. And one of the questions I asked them, I said, what would you have done differently last year than you would have done? What did you learn from last year? What was your biggest mistake, let's say? And they said they didn't invest enough in the stock market. And I'm kind of chuckling when I kind of thought that. It's like, you would kind of think that they should have had a plan. They should have known what to do or be more systematic. I mean, I'm not judging them. They're managing a lot of money, tremendous amount of money. But the reason I'm chuckling is I also expressed to them is that currently yesterday before Yellen spoke, we had 7 distribution days on the NASDAQ. And after she spoke, we have 8 distribution days. And the clustering of these distribution days is extremely not favorable for the market. And here's this huge fund of funds where they have about $700 million under management, and they're wanting to get more exposure to the stock market where potentially, again, we don't know the future, that there could be some dark clouds on the horizon. And I expressed to them I used very simple rules. I talked about the distribution days, even though we were more focusing on commodities, and I'll get to that a little bit. It was interesting too. But I said, hey, these very simple rules. One of them is the distribution days. The other is moving averages. And I said, we're pretty much very close to taking out these moving averages and percentages falling off the high. All of the above are not signaling a favorable period. But you have to take it day by day, and the market can rebound. Anything can happen. And that's one thing that what you need to be as a trader or an investor is you need to be flexible. You don't want to be a bull. You don't want to be a bear. You want to read what the market's telling you. And again, there's going to be many, many times that you're, let's say, wrong and the trades don't work, and that's okay as long as you attempt to keep your losses small. The other interesting thing, I mean, again, this is a very specific niche, and it also, I want to first say, past performance is not indicative of future performance, and commodity trading is not for everyone. It's really not for a lot of people. It's very volatile. It can be at times, as much as stock trading can be also very volatile at times. But what also was a very interesting thing with this fund of funds, what they brought out was they felt comfortable investing into the very, very large CTAs, such as Winton, which is something like 20 some odd billion dollars, or AHL, or Aspect, or Blue Trend. And to some degree, people feel because a fund is large, they feel they're insulated. And I'll tell you not. That I think anything can happen. Even these big funds can have issues and have big losses. And the other thing is these big funds are limited to the positions that they can take. And they can only take the most liquid markets. And it also opens up a whole arena for emerging managers like myself, like what I was trying to tell them. And I gave them examples. I showed them some of the more liquid markets, which again were some of the meats, such as lean hogs, which have been trending tremendously. I don't know if they're going to continue or not. Been in that trade for a long time. And also feeder cattle, live cattle have been trending. And actually, there was an article in Zero Hedge today talking about the price of beef going up so much. And they also were very strongly condemning trend following. The trend following doesn't work anymore, and if it starts working, they'll invest in it, which has a good point. But I've showed them the meats. I also talked about coffee. And coffee almost doubled within a very short period of time. And again, these large funds can't go into it. So what is the summation of all of this? Institutional investors are always the best investors. What I gleaned from this conversation, and I'm not going to say the name of the organization, is that here we are going into potentially a rougher period in the stock market. We don't know. I mean, again, we can turn down and then turn right back up, or we can turn down and keep on going down. You never know how bad it can get, or how long the downturns can last, or the upturns can last. But I thought it was pretty ironic that they're looking to invest more money now, almost late in the game. And again, with trend following on, let's say, commodities, which has been very, very tough. It's really been probably one of the longer periods for me as far as drawdowns. And I told them that. I said, this is the reality. It has been very tough. It's never easy, and you always have losses and long durations. But I said, potentially you want to think about the opposite. This possibly could be a contrarian move. And again, they didn't really buy that. So bottom line is this. You need a trading plan. You don't want to just go on your opinions. You don't want to chase performance. And that's what these people were doing. They're chasing performance, past performance. And past performance is never indicative of future performance. You need to think a little bit outside of the box. Again, this is Andrew, Trend Following Mentor. Thank you. And if I can help you in any way, please let me know. I teach how to become better traders, investors, both the methodologies and the psychology. Thank you.